Welcome back to Your Average Investor, the channel that looks at my journey through investment, budgeting and finance. When you start investing, it can be quite difficult to understand actually how you make your money and where you get your return from. So today, this is what we're going to look at. We're going to break down an investment and look at how you make your money. We're going to look at capital growth, dividends and the compounding effect or compound interesting, which is absolutely key for long-term investing.
The types of return you can expect to make on your investment depends largely on what the investment actually is. These could be something like stocks and funds, bonds, property, paintings, or even classical cars. Some of these are concerned with merely capital growth. However, if you're invested in stocks or funds, sometimes you will be paid out a dividend depending on the stock or fund you're invested in. Equally, if you're invested in bonds, you can expect a monthly, quarterly, or annual payout. For the purpose of this video, we're going to concentrate on stocks and funds. Firstly, we'll take a look at capital growth and how this affects the value of your investment. On screen, you can see the value of Amazon stock over time, from its initial flotation on the stock market to the current day. The value of Amazon stock has increased over time as the company has become more profitable and more well known. Capital growth occurs over time and it can be put down to several different factors. Some of these are the growth of the company, an increase in profits or revenue of the company, if the company has a strong future or has strong financial standing, or if the company is in the process of developing a product which will help us in the future. Any of these factors will make the company more valuable and therefore the stock price will increase. If you are invested in this company, the value of your investment will increase alongside this. This can occur year on year, meaning that the value of your investment will continually increase until you decide to sell that share. This process is also helped by compound interest or a compounding effect. An example of this would be in year one if a stock cost £100 and you purchased it for £100 and it increased by 10% in that year, the stock at the end of the year would be worth £110. Then the next year, if the stock again increased in value by 10%, that £110 would now become £121, meaning an increase of £11 within the second year of investment. While the value of the stock has increased by 10% both years, the overall increase in the value of your investment from £100 to £121 would be 21%, greater than the sum of both yearly growths. This in essence is the compounding effect, and it can really help to springboard the value of your overall investment over time. We can see how that's happened here with the Amazon stock. With the value of the stock slowly increasing, you can see that towards the end of the graph, this compounding effect has really had time to take hold, and therefore we see this exponential growth in the value of stock. Obviously, your capital is at risk whenever you decide to invest in companies or funds. However, history does suggest that the trend of the value of stocks is upwards, but the past cannot predict the future. The way you would make money through capital growth then is when you eventually sell the stock at an increased value to what you bought it. Obviously, the longer you are able to hold on to a stock, the more this compounding effect has chance to take hold, and therefore the greater increase to the value of your portfolio over time. We can see the same effect of compounding occurring for this Vanguard S&P 500 ETF. The S&P 500 is well renowned for having one of the longest bull markets in history, and you can see how that's affected the value of this ETF over time. To realise the increase in value from the capital growth, you obviously have to sell your stock and end your position within that company. There is, however, a second way that stocks will make you money, and that's through dividends. A dividend is a payout from a company or a fund based on the performance of that company within a quarter or a year. These can be taken to reinvest back into your portfolio or withdrawn as income. Johnson & Johnson, as you can see on screen, is a very good dividend company, and it gives a dividend yield of 2.58% yearly, and that equates to around $4.04. The dividend yield is calculated as a percentage of the stock's current value. You can see on screen a history of the dividends paid each quarter from Johnson & Johnson. An example of a fund that pays a dividend would be the Vanguard FTSE 100 ETF, which currently yields a dividend of 5.73%. This is paid quarterly. As you can see on screen, the most recent dividend payout was 37 pence per share. Therefore, if you have 100 shares in the FTSE 100 ETF, you would make around £37 in dividends each quarter. This could obviously be taken as income or reinvested back into FTSE 100 ETFs to increase the amount of dividends you would make in the future. Again, this will stimulate the compounding effect over time. This graph on screen really shows the power of reinvesting your dividends. You can see a FTSE 100 tracker without dividends reinvested versus the same FTSE 100 tracker with dividends reinvested. From the 30 years shown on screen, and from an initial £10,000 investment, where dividends had not been reinvested, the total value of the investment ended up around £30,000. Whereas where you had reinvested dividends, the same £10,000 initial investment equated to almost £100,000 in value at the same point. This shows almost a £70,000 difference by just not investing your dividends. The Schroders website investigated this by looking at 8 different markets and the average annual return. They assessed that when dividends were not reinvested, the average annual return was 4.3%, when compared to a dividend reinvestment strategy which yielded a 7.1% annual average return. Using this compound interest calculator, we can see the effects of reinvesting and not reinvesting dividends. I've entered the base amount of £500 as this is the initial minimum lump sum investment you can make through the Vanguard platform. I've attached a yearly growth rate of 4.3%, which is what the Schroders website suggests you could expect to make if you're not reinvesting dividends. And I've set the calculation period to 40 years. The compounding interval is obviously yearly, and I've also set a regular monthly deposit of £100. The calculator then gives us a number of different figures over the 40-year period. You can see that in year 1, £1,200 was invested throughout the year as part of the £100 monthly instalments. While the yearly deposits remain the same, you can see that the yearly interest or growth continually compounds and increases. And that greatly impacts the balance you can see on the right-hand side throughout the years, starting from an initial balance after year 1 of £1,749 through to year 40, where the final balance would be £127,963. All in all, for this value, you would have invested £48,500. £79,000 of that would have come from capital growth. But bear in mind, in this example, dividends have not been reinvested. By changing the yearly growth rate to 7.1%, which is what you could expect to make if you were reinvesting dividends, and keeping everything else the same, we can do a direct comparison between the total value of the investment. You can now see that the yearly deposits stayed exactly the same as the first example, at £1,200 consistently throughout the 40-year period. However, one thing to note is the increase in balance at the end of the first year, from £1,749 to £1,781 seen in this example. Because of the increased growth percentage due to the reinvestment of dividends, the effect of compounding is much larger in this example. If we take a look at year 40, when this example investment would have matured, you can see that the total investment made would again be £48,500. However, where the growth in the first example was £79,000 where dividends had not been reinvested, in this example the growth is £214,450. That's almost 3 times greater than not having reinvested dividends. Again, looking at the total value of the investment, in the initial example, where dividends had not been reinvested, the end total value was £127,963. In this example, the end value is £262,950. That's a total increase in value of £135,000 just by reinvesting those dividends every time you get them. It's information and calculations like this that really caught my imagination when I first got into investing. By investing just a small amount each month, in this example £100, you can see that that can grow into something very sizable, and if you reinvest the dividends you get, it will be a much more substantial final amount. As I've said, it may be your decision to take the dividends as income rather than reinvesting them. However, at the moment, I've decided that the reinvestment strategy is the best option, as this will see my portfolio grow much greater than if I didn't.
The sooner you start investing, the longer this compounding effect has chance to take hold, and therefore the value of your portfolio will increase. If you found this video useful, please like, comment and subscribe. And if you are new to investing and looking for your first investment, why don't you check out my video on the Vanguard Life Strategy 100% Equity? It could be the perfect start for you. And with that, I'll see you in the next one.